Welcome to the June 2022 Advanced Projections Monthly Economic Report. This is coming out on about June 20th, which is a week or so later than usual, but we wanted to make sure that we had all the input from the Fed meeting into our report statistics, so that will be covered as we go through this. First, let's look at the economic highlights for May 2022 and the early part of June here. Employment figures for May came in with a still solid new jobs figure up 390,000, which kept unemployment unchanged at 3.6%. We are essentially back to the same labor picture as in February 2020, just before the pandemic. These levels have the Fed fully focusing on inflation, as was confirmed by Chairman Powell back on March 2nd and confirmed by another Fed governor's presentation in Germany on May 30th. Annual inflation through May was announced on June 10th with consensus expectations for it to be about 8.3%, and the reported actual value was 8.6%. This is in line with our expectations, and we expect to see another 8.3 to 8.5% figure for June as well. The Federal Reserve Open Market Committee June 14th and 15th meeting confirmed our expectations of an aggressive Fed plan of action to address high inflation as unemployment continues to stay well below 4%. At this time, the FOMC announced another increase in the target Fed funds rate from 0.75% up to 1.5% by adding that 0.75% to the May rate, along with accompanying plans for additional increases in the near term. Minutes of the FOMC meeting will likely reveal that the Fed will be resolutely contracting the money supply by unwinding its balance sheet, removing $100 billion or more perhaps per month. AP has been keeping you updated with the most recent significant recession indications, pointing more strongly than prior public statements from the financial community. We now see that already changing as reality starts being acknowledged in the broader media coverage. Residual pandemic effects were far less related to illness than to still ongoing supply chain and labor shortages, which we feel will continue to affect the economy for many more months. U.S. COVID fatalities continue to decline to below 200 per day and now declining rapidly below 100 per day. At the end of this report, we repeat and emphasize our historic warning based upon our expectations for an increase in the vigor of Fed upward interest rate moves, plus the international political, oil, and now food price shocks. These are precisely the something else that we said was required to kick the market solidly into their long overdue corrections. With the additional concerns about recession now widely entering public discussion, markets will likely keep pointing downwards for several months. Later in this report, we present a first-pass estimate at a charted landing zone for the S&P 500. For our indicator status at the end of May, 3 of our indicators have now moved from their prior first quarter status to further indicate the increasing probability of a recession. Our indicator system moved up on our recession risk level from 60 to 75% this month, due to the first quarter GDP contraction, expectations for continuing downward trends in liquidity, lending rates, and consumer confidence, as well as newly declining leading economic indicators and a hawkish Fed interest rate increase. Unemployment's dip over the past several months is maintained, remaining at 3.6%, as we said earlier, with the new jobs gain in May of 390,000. We expect those gains to continue in a restrained fashion with the Omicron wave essentially gone, and then bump up with the warm weather of summer. The May report included hefty increases in hiring in leisure and travel industries. we had seen others project that unemployment will reach 3.7% by the end of the year, but of course it's already below that, and our own figures fell into the 3.3 to 3.5% range, and we're nearly there already. There are approximately 2 job openings being advertised for every unemployed person who is looking for work. Year-over-year consumer price index increases and supply chain issues have continued to plague many aspects of the economy, keeping prices and inflation expectations elevated as demands remain above available supplies. Consumer price index figures confirmed the onset of inflation during the second quarter of 2021, and they have continued to rise. The March number was 8.5%, April was 8.3%, and as we expected, a hot May number of 8.6%. Everyone should expect at least a few more months that are in the range of 8 to 9%. With the June 15th FOMC announcement, our previous month's forecasts of 0.5% rate bumps have been moved upward to 0.75% for this and the next rate increase to be announced in late July. There will be a 2-month gap between the July and September meetings, FOMC meetings that is, so these moves are designed to have a slightly greater impact than 3 consecutive monthly increases of 0.5%. By the time the FOMC announced their June rate hike, the yield curve had already priced in a 50-point move, with every element of the yield curve moving upwards between May 31st and the June 15th rate hike. The latest inversion that currently exists is a minimally growing one, where the 3- and 5-year yields exceeded the 30-year by 0.16%. That was as of the FOMC announcement on the 15th. The rate spread that we watch, 3 months versus 10-year yields, has contracted from a May 2nd difference of 2.09% to a June 15th difference of 1.59%, with more contraction in this spread expected through the summer. Second quarter corporate earnings estimates for 2022 have been tempered substantially, dropping by 1/3 since the beginning of this quarter and are continuing to be revised downwards. Companies have now returned to the practice of citing lower expectations in the coming quarters. In recent earnings calls, over 80% of the S&P 500 companies cited inflation as a high concern, certainly with regards to material costs as well as labor costs, and anticipated continuing upward pressure on those elements. Analysts are clearly not yet fully factoring in what we expect to be significant real declines in consumer spending due to inflation and rising interest rates. Now, here are the current underlying socioeconomic details. First, the current employment picture. During May, unemployment maintained a national level of 3.6%, with an about as expected jobs gain of 390,000. That combination translated into a continuing trend of more job seekers re-entering the jobs market. In spite of past pandemic-related declines in the labor force, the participation rate began to move upward again, beginning in late fall of 2021, and it continues to move up, as is the total number of employed persons. We're including the standard monthly household data summary table A from the Bureau of Labor Statistics, which shows the employment situation at the end of May, along with the general improvements in the employment picture we have been experiencing over the past 3 months as compared to a year ago. The current high employment situation also keeps the Fed absolutely free to be as aggressive as they deem necessary in their rate increase script, plus their plans for unwinding their balance sheet, which translates into decreasing the money supply. They have already stated so with their March, May, and June rate increases and within their meeting minutes. Look for increased activity in these areas during the summer. Note, as is usual in the hindsight-based discussions in the popular financial media, there is a lot of criticism of the Federal Reserve for not addressing incipient inflation 1 year ago when the CPI index started to increase faster than normal. We do not criticize them in hindsight at all. Here's why. The Fed prioritizes employment levels over inflation when the former is bad. A year ago, unemployment was still 6% and declining slowly. The Fed wants to have unemployment at 4% or lower when they start increasing rates, so there is some wiggle room in employment as the economy slows down in response to rate increases. At last May's unacceptably high 6% unemployment, there was no wiggle room at all. This precluded them from beginning any form of tapering program at that time and throughout the middle of 2021. What happened after that, while unemployment slowly declined toward 4% by the end of 2021, were two new sweeping waves of the pandemic, which could hardly be anticipated by anyone. The Delta wave was quite deadly and certainly capable of threatening any fragile recovery in the economy, so the Fed's hands were still tied. They could not create any premature expectations of tapering until the further threat to public health was seen as limited. The Fed provided a fairly gentle tapering script in November of 2021, around the time Omicron was spreading through the population. The markets and the economy basically ignored that script until new inflation figures came in and made the Fed accelerate their script in December of 2021. This finally sank into the heads of investors who began leaving the markets in early January of this year. The increasingly aggressive rate increases, sequentially 0.25%, then 0.5%, and then 0.75%, these moves are doing what they are intended to do. That is, allow skilled planners and investors to adapt to the new environment and have some forward-looking perspectives about the economy. This past week's 0.75 point increase already has had some effect on the price of oil, driving it down 10% and hitting energy exploration equities hard as well. And we have a chart included in our written report that shows this quick 10% decline last week. Now, for equities in general, in our May report, we said this: we expect further downside to the S&P and other indices over the coming weeks. Breaching of official bear market levels of minus 20% are highly likely by the end of June. Index volatility is also to be expected. Well, this prediction has already come true. During May and through the first half of June, the equities markets continued on a volatile but downward path, setting new 2022 lows here in mid-June. Between 2022 highs set very early in January and back in November for the NASDAQ, and closings on June 15th, the Dow Industrials were down 15.6%, the S&P was down 21%, and the NASDAQ was down 31%. All solidly into correction territory, and of course the NASDAQ and S&P are now both in bear markets, down more than 20%. We expect significant further declines in equities and bonds. A return from the current still in the bubble territory to warm market levels would take the S&P down to about 3650, and a correction to the mean would be near 2900. In a typical bear market, negative emotional moves carry enough downward momentum to drive indices below the mean, towards the inevitable emotions of despair and capitulation when finally the selling ends. There is no current reason to expect anything different this time. With increased energy prices and profits and higher interest rates on the horizon, energy companies and banks may continue to look strong in the next quarter or two ahead. However, even those may be weakening due to the aggressiveness of this and upcoming Fed moves. The broader equities market should be looking 6 to 12 months ahead, where the estimates for S&P 500 earnings and revenue growth are likely to be far less optimistic over the coming months. We monitor margin borrowing as one of our tools for indicating speculative excesses in the equities markets and for breakdowns in this metric which appear ahead of real economic downturns. Margin borrowing is finally moving off of historic highs and decreased by 3.6% in March and another 3.3% in April. This is evidence of something that is seriously discouraging even more of the risk takers from borrowing to finance equity speculation. And we have our usual chart courtesy of Advisor Perspectives, which illustrates what's been going on with margin debt with the latest available data through April. Now, briefly on the pandemic, by the end of March, total U.S. COVID fatalities reached over 1 million. However, the daily new case and fatality rates have finally declined to less ominous levels. For our complete COVID-related hospitalizations, ICU occupations, recession indicators, and recession continue to decline during May. You can get against the backdrop of a recent small upward trend in new cases. Be sure to like this video and subscribe to our channel. Daily fatality rates have declined substantially. Feel free to leave any questions you may have. Barring any nasty new variants that could pop up, we should expect a general domestic return to normal for tourism and other social activities during the summer. For example, we point to the robust hiring found in the leisure and entertainment sectors during April and May. Our expectation for the end of the pandemic, barring any aggressive new super variants, was for the average U.S. daily fatality rate to fall below 400 per day and stay there. So far, so good, as the most recent 7-day average was below 250, far less of a horrific number. This is well within the ability of our social fabric to tolerate given new and more effective treatments or preventatives. This sort of fatality rate puts COVID on par with nastier seasonal influenzas, but we are not making the mistake of trivializing the consequences of COVID on the more vulnerable people from a health standpoint. If the current Omicron variants of concern remain as manageable and minimally fatal infections, we will keep watch over it, but no longer report on details of the pandemic and its evolution. Should that not be the case and something nasty pops up again, we will, of course, include its progress and effects in our reports. For our complete monthly macroeconomic report, including current recession indicators and recession probabilities, you can get free member access via the link in the description below. Be sure to like this video and subscribe to our channel for pertinent economic updates. Thank you. Feel free to leave any questions you may have in the comments below.